Friday the 6th of May. Complete roller coaster this week and today. We finished at just up 659 crowns for the week, 114,636 crowns. It's amazing that the portfolio hasn't imploded. And for the year, we're up over 500,000 crowns, 535,873 crowns for the year. And looking at the current exchange rate, that's a touch over 50,000 euro, or roughly 54,000 US dollars. So to pivot over to the percentage return, we see that we're up 30.17%. And at one point on Tuesday, we were up 32%. Sliding over to the weekly return, we see we're up 6.71%, which is quite incredible considering the up and down roller coaster week that the Standard & Poor's 500 has gone through. You see here that midweek on Wednesday, the market started to descend back down, and this was off the back of the Federal Reserve increasing the interest rates by 0.5 percentage point. This resulted in the S&P falling back down, and for the year it's gotten worse. It's down minus 14%. Zooming out on the different time frames through the monthly, the quarterly, and through the trailing year, we see that we're still quite ahead of the broad markets. Of course, the big news was midweek when the Federal Reserve got up and told everyone that they were going to raise the interest rates by 50 basis points. The 0.5 percentage point increase was in line with market expectations, but the rate move was the largest since 2000. And of course, this is to try and combat the burgeoning inflation. Jerome Powell went on to say that inflation is much too high and that we understand the hardship it's causing, and we're moving expeditiously to bring it back down. He noted that the burden of inflation on lower income people, saying that we're strongly committed to restoring price stability. So how did we even get here in the first place? Well, a lot of it's got to do with the corona pandemic and the responses from the governments and central banks around the world. Just want to go ahead and throw this article in your face, and in it says that COVID costs totaled $5.2 trillion, which costs more than World War II in today's money. Also, total money printing totaled to $13 trillion as of mid-2021. This article goes on to say that in total, the relief packages amount to $5.2 trillion, which is about 25% of GDP. Looking at it through another lens, it's more than all the wars combined since 2001 the US has been involved in, and more than World War II, the cost of World War II itself. Having a look at this diagram, we see where the $5.2 trillion has actually gone, and we see that $1 trillion of it has gone directly to taxpayers. And of course, this was in the form of personal relief checks that they doled out to everyone really early on the piece. Reading a little bit further on, it says demand pull inflation occurs when there's too many dollars chasing too few goods. Further, the money supply normally grows at about 7% per year, but quantitative easing of more than $4 trillion has increased it by 14% per year over the past decade, and in total, the $5 trillion COVID relief increased the money supply by 27%. Having a look at this trend line, we see that the higher money supply, the higher the heightened risk of inflation is. Just to drive the point home, this article is about the supply and demand imbalance caused by the COVID pandemic. Yeah, again, so my point isn't to bore you with specifics, but I just want to point out some interesting things in this article. Halfway down the page, we see that fiscal stimulus boosted the consumption of goods without any noticeable impact on production. So it widened the gap between demand and supply on the goods market. As a result, the fiscal support, read this as printing of money, contributed to price tensions. A back-of-the-envelope calculation suggests that all that money printing has contributed to the increase of inflation of about 2.5% in the US, 1.5% in Canada, and 0.5 percentage point in the UK. This bit's the kicker. Due to a mix of government-imposed restrictions and individual decisions, mobility levels collapsed in March of 2020. This is important because the modern economy requires a constant interaction and mobility of participants and resources. In fact, there's a metric that is used, which is velocity of money, which is used to gauge the economy's health. I'm not going to get into what velocity of money is, but the modern economy requires constant interaction between businesses. The long of it short is all those mandates and mobility restrictions hampers a firm's ability to produce. The rest of the article is just esoteric information with graphs and lines, but draw your attention to the conclusion. The COVID-19 pandemic gave rise to a very peculiar economic shock affecting both firms' ability to produce and consumers' ability to consume. The fiscal policies of most governments in advanced economies were successful in boosting consumption. However, together with relatively inelastic supply, it may have led to supply chain bottlenecks and price tensions. So now we find ourselves in this situation, high inflation, and to combat that, the Federal Reserve has to raise the interest rates quite aggressively. So we're getting forced down a situation where it could spiral uncontrollably. This article in Investopedia shows what the lifting of interest rates does to the US dollar. When the Fed increases the overnight funds rate, that generally tends to make the US dollar a lot stronger. Now this is so because the higher yields attract investment capital from investors abroad seeking higher returns on bonds and interest rate products. So what eventuates is a supply and demand dynamic, and with a higher demand for the USD, this drives the price of the dollar up. Since Wednesday, when the Fed came out and said that they were going to raise by 0.5 percentage point, the US dollar surged against most currencies. Looking at the Swedish crown US dollar currency chart, we see that it's back up to nearly all-time highs. Looking at some of my holdings, you see that the yield on costs only a couple of weeks ago on ExxonMobil was 8.22% at the time, and now it's risen, it's shot up to 8.6%. If you're not sure what I'm on about with 8.22% yield on cost, just go back to a couple of videos I posted a couple of weeks ago, and that explains. This now works in a circular motion. With higher inflation, the Fed is expected to raise interest rates more. With higher interest rates, the dollar rises up, and with a higher dollar, my yield on cost on these holdings further go up. And I don't see inflation going away anytime soon, and so I don't see this dynamic changing anytime soon. Further compounding this is the current talks about an embargo on Russian oil. In fact, an embargo on Russian oil would at the very simplest way drive the price of everything up. We already see that the price of crude oil is already up to over $110 a barrel. Finally, the icing on the cake, oil is settled in payment with US dollars. And so we know that that's rising. So now it's going to cost even more to buy the dollar to settle the oil payments. And all this is going to be priced into higher inflation. And what we have is a spiral out of control. All of those dynamics actually help in aiding my portfolio and its performance. So yes, whilst inflation does affect the real rate of return, meaning the 30% that I'm up this year is only actually up 22% if inflation rate's 8%. I'm able to sidestep that drag by taking advantage of geographic arbitrage, meaning I'm earning in a modern developed economy, albeit inflationary, but I'm not having to spend that in the same inflationary environment, so thereby sidestepping the ravaging effects of inflation. Ultimately, I don't care how high inflation gets, because all it does is adds to the bottom line.